there's so many things going on right now that drawing attention, or that should be drawing attention, because the economy, obviously, we've got all kinds of weird things going on between the trade wars on the one hand and a lot of indicators of an upcoming recession on the other hand, and equities are set up for a crash based on history. Every time we've been at these valuation levels, the next couple of years have been brutal, and then geopolitics is still really unsettled, and these multiple scandals are potentially big deals for the financial markets, just because when politics is unsettled, so is finance usually. But the whole Epstein thing followed by the Trump-Russia collusion thing, these are all really big deals. But as a gold bug, I'm still paying attention to gold and silver more than anything else. And right now, gold is consolidating, which means it's just trading back and forth in a really narrow pattern as it figures out what to do. And that's not a surprise at all, because it had a phenomenal 2-year run. It's up $1,000 an ounce in just the past 12 months, which means there are a lot of people with profits to take in precious metals right now, especially gold. So they're selling, but new people are coming in and buying, and you get these up and down days that don't really amount to much. And that's basically a healthy thing in a bull market. You've got to have consolidation periods while the weak hands hand off their assets to the strong hands, who aren't going to sell at this price for any reason. And then you can resume the upward momentum again. So that's probably what's going to happen with gold. But meanwhile, silver and platinum are outperforming gold, which is a really good sign, because that means the commodities bull market is broadening out. You don't just have one or two things leading the way and everything else lagging. So basically, this is a healthy environment for commodities in general and precious metals in particular. So basically, despite all the crazy stuff going on, I'm pretty happy with this central thing that I pay attention to. But all of this other stuff could change that on a dime. There are all kinds of things that could happen that would go from being ominous to terrifying in a heartbeat. There are good fundamental reasons for precious metals to still be rising. And this might be a good time to segue over into the whole Fed debate that's going on right now, where Trump, who is an easy money guy, wants lower interest rates. He's been buying real estate for 50 years, and cheap money is the way you do that. So for him, lower interest rates are just a no-brainer, especially if you have the power to make them happen. You obviously make them happen. So he's bullying the Fed right now in various ways and demanding that they lower interest rates, and he'll eventually get his way. Either the Fed will capitulate and start cutting, or the Fed governors will leave and Trump will put his people in who will just immediately lower interest rates back to zero or someplace like that. So that's a very positive thing for precious metals. If you've got lower interest rates in the not too distant future, then that's the kind of environment that you like to see when you're an inflation hedge. If somebody's buying gold and silver because they're afraid that the dollar is going to be inflated away, well, let us move interest rates down to zero again while running massive deficits. And you've got the environment where the dollar is being inflated away, and you want to be in things that will protect you from that. So that's probably a 50-50 bet right now for our future of the next couple of years, where we're back to aggressively devaluing the dollar, and the things that benefit, the real things, are doing very well. Well, the bond market is worried about what falling interest rates would do to the inflation rate and to bond valuations, and they're demanding a higher rate of return when they invest in bonds. When you invest in a bond, you basically lend money to somebody who promises to pay it back to you in a future date while paying a little bit of interest at a time on a monthly basis or whatever. And if you're worried about the future, you're less likely to lend in that way by buying bonds, and you want a higher interest rate to make it worth your while. So that's what the bond market is saying. They're saying, well, okay, if you're going to be reckless with monetary policy, then we're not going to go along with this. We're not going to accept lower and lower interest rates just because you tell us to. You got to behave in a way that makes us comfortable with the inflation rate of, say, 2 years to 5 years hence. And the bond market is not comfortable right now, not just in the US, lots of other countries' bond markets, notably Japan's, are having the same kind of behavior where, the government may want lower interest rates and start lowering interest rates in the short end of the spectrum, but the bond markets don't cooperate and long-term rates go up. Now, this becomes a big problem if interest rates go up too much, because long-term rates will choke off economic growth if they rise beyond a certain point. Mortgages, for instance, key off of the 10-year treasury yield. So let the 10-year treasury yield rise from here, and that means mortgages go up. It also means car loan rates go up. So you can choke off economic growth if long-term rates go up too much. And you can also bankrupt governments who have to pay interest on their debt and who are accumulating a lot of debt. The U.S. has $1.5 trillion in interest expense already per year, and we have to borrow that, which raises the deficit in the future, and debt piles up even more, and our interest, we have that kind of a death spiral thing going on if we can't lower interest rates across the yield curve. So this is a big dilemma and a potentially big crisis if it doesn't work. If easing doesn't work, in other words, if it makes long-term interest rates go up, then we're out of tools. There's no way to fix an over-indebted financial system if you can't inflate away the debt. And that's a very real possibility in our future. If we cannot liquefy the system in a way that makes long-term interest rates dramatically lower, then we're done, as a financial system. And I think that day is out there waiting to happen. There's always going to be a time when the tools for inflating away debt no longer work, and the whole fiat currency experiment just breaks. And it feels to me like we're close to that because government interest costs are going up dramatically while long-term rates are not falling. So that's the beginning of that kind of a process. So watch it. And if it doesn't change over the next, say, 6 months to a year, then that's a sign that the experiment is ending and something else has to be put in its place. And the governments of the world either have to choose to do it right away preemptively or have to wait for a gigantic crisis to come when they're forced to do it. So either way, you get a monetary reset out there. And it's just, how big is the crisis before it happens? It's hard to say because there are so many cross currents right now, because you showed M2. So the money supply is starting to increase again. Gold is up, which is an indicator that people are worried about inflation and financial instability. Bond yields are up, which is a sign that the bond market is worried about rising prices in the future. So there are indicators that we've got a burst of inflation coming, but at the same time, you've got a lot of deflationary indicators out there. Consumers just don't have much money left. And American consumers in particular are starting to put day-to-day life on credit cards, which is a sign that we're basically towards the end of that particular trend, because you can't really function when you're carrying balances on credit cards that are charging you 25% a year. That's a sign that you're going bankrupt, not that you're going to embark on a new burst of consumer spending. So, it's really hard to say, because a stock market correction, like an equities bear market, is deflationary, and consumers pulling back because they've got too much debt, that's deflationary. So I don't know. I think there's a case to be made for carrying some stock market shorts right now in anticipation of maybe a deflationary event at some point. Like if interest rates spike, long-term interest rates, that's a very deflationary event that would be pretty hard for the rest of the financial market to ignore. So, I've got some NASDAQ put options, some long-dated ones that I've got for insurance against a deflationary event. And then, of course, a lot of precious metals and related things that are bets on continuing inflation. But I don't think we can know for sure which of those we're going to see in the next year. Either one is completely feasible given all the stuff that's going on out there. And then we've got all the political and geopolitical stuff that kind of right now would be classed as gray swans, stuff that could happen. We could see it maybe happening, but it's not yet. But if it happens, it could happen suddenly and scare everybody. So there's a potential mess, multiple potential messes out there of various kinds. And I think all you can do is insure against the seemingly the most likely ones, and then hope that your insurance pays off enough to offset the damage that the event does, whatever it does to you. We could get sucked into Ukraine, where Russia and NATO start shooting at each other, and then we're kind of sort of in a shooting war against nuclear power. We're not past that yet. It's not as big a deal as it was under the Biden administration, where we seem to be actively trying to make that happen. Now, Trump doesn't want it to happen, but the other parties aren't really cooperating. And so, something like that, which I don't expect to happen, but could easily happen with all the parts that are on the game board right now. That would be horrendous for the financial markets. If two nuclear powers start killing each other's soldiers, and then a financial crisis in some other country. We're not paying that much attention to Japan or Germany or places like that, but they're screwing up their culture. Well, in the case of Germany, their culture. as well as their finances. In Japan, they're screwing up their finances monumentally. The Japanese government has more debt per capita than any other country in human history, I think. And their interest rates at the long end of the yield curve are starting to go up, even though the government doesn't want them to go up. And the government owns like half the bond market already. And so it's not clear that there's an easy fix for Japan. They have some serious demographic issues too. But let the Japanese economy fall into some kind of a crisis. And nobody expects that right now because people have been talking about it for a decade and it's never happened. But let it happen. And that's a really big deal for us too, because Japan owns a massive amount of US Treasury bonds. So were they to have to start dumping those bonds, that would spike our interest rates. There's something like that could happen with pieces of the puzzle that are already out there. You can see them, see how they fit together, and you just don't expect it to happen right away, but it could happen. So that's the kind of thing that could just blow up the US stock market and maybe the bond markets too. And, Europe is such a mess right now. They're committing cultural suicide, and there isn't a day goes by when there aren't more videos of really authoritarian stuff happening over there. At the same time, their economies are extremely weak. They're not keeping up with the rest of the developed world. And so the Eurozone could have a crisis that leads to either the breakdown of that currency and the Eurozone members going back to their old currencies, or some kind of a bond market crisis. That there's a lot of Euro debt existing in the world. So if that debt starts to default in one way or another, there's a lot of potential bankruptcies that flow from that could impact the US too. So yeah, stuff like that. It could happen. Probably the odds aren't good that they will happen, but there's enough of them out there that the odds of one of them happening is actually pretty good right now. So we'll see. All we can do, again, is diversify in preparation.